rolling on, and there's some big prominent consumer names that are still coming out. And I wanted to take a look at what do those earnings charts look like because the consumer companies have been reporting better than expected results. Will this continue as we head into the retailers and even more of the consumer names here to wind down this earnings season? I picked out 5 must-see earnings charts for this week, including one energy name that I stuck in there in honor of Berkshire Hathaway. What are they? Let's take a look. The first earnings chart is Airbnb. And as you can see, they've put together quite a nice earnings surprise track record after a little bit of rockiness there after they went IPO in late 2020. Now, a lot of people thought they were a little crazy to go IPO during the pandemic. If you recall, late 2020 is just after the vaccine was announced, and still travel was not good. But everybody was trying to escape the cities, trying to go out to the country. And that was one of Airbnb's fortes. So it's been a wild ride on the stock, as you can see, bottoming there in late 2022. But it's had quite a rally here in 2023 as travel remains strong and Airbnb bookings remain elevated. Shares are up 47% year to date. Now, it's not a cheap stock, even though it's come down off those highs. It's still trading at 35 times forward earnings, but it does have positive earnings. So, what will Airbnb say this quarter, and what's their outlook looking like for the summer travel season? This is one to watch. Then we're going to switch it over to another strong consumer name. I've talked about it in the past, Boot Barn, ticker BOOT. And they've only had that one miss right when the pandemic hit there in 2020. And then otherwise, they have the great earnings surprise track record. However, these shares rallied big during the pandemic. Why is that? Well, Boot Barn obviously sells boots. It sells Western and work-related footwear, apparel, and accessories. So a lot of their work-related are the types of shoes, say, like nurses would wear. And that was also spurring sales there during 2020 and 2021. But it's come off those highs. It is a lot cheaper. It's tried to rally here in 2023, thinking maybe the worst is over. It's up about 15% year to date. And it's cheap, as I said, trading at just 12 times. But what is the rest of this year supposed to look like for a company like Boot Barn? Usually shoes do well in recessionary time periods. Is that going to be the case? We will find out. Then I'm going to switch it over to the oil company I promised that I'm putting out there as a little gift to Berkshire Hathaway. Yes, if you're a Berkshire Hathaway shareholder, you own a big chunk now of Occidental Petroleum, ticker OXY. Berkshire continues to buy it this year in 2023. As these shares have come down off those highs in 2022, Buffett has seen or thought that this was a buying opportunity here, even with the 2 misses we see there in the last 2 quarters. But I'm not too concerned about these earnings misses in recent quarters by the energy companies because the estimates have come down as oil and natural gas prices have come down. And it's kind of a very difficult environment for the analysts to get a handle on what earnings are actually going to look like as those prices come down. So they've been getting it wrong a little bit, but those are small earnings misses there. Not too concerned about it. Year to date, however, the shares are down 6.4%, and that's why Buffett has been buying because they have weakened. Occidental trades with a forward PE of just 10.5, so it is cheap on a PE basis. It does pay a dividend, but it is on the lower side of most of these bigger oil companies because they've been spending a lot of their cash on the debt. But the dividend is yielding 1.2% here. So this is one a lot of people on the energy side are going to be watching this week. Then we're switching over to the juggernaut. Also on the consumer side, Disney. We've talked about it the last couple of quarters because, as you can see from the chart, it's been having some difficulties. It's well off those 2021 highs now, even though the parks are packed and everybody is, again, traveling, even internationally. They are coming off a big beat last quarter. That helped boost the shares up a bit. They are up 18.5% year to date, but over the last 2 years now, down 44%. And the shares aren't even cheap here, trading at 25 times. So a lot's going on here with the streaming, with the parks, just what's happening with the movies, just a lot to tackle with Disney, and also whether or not the dividend will ever come back, I think is another question. So Disney, this is one we're all going to be tuning in on. Then I'm going to wrap it up with Yeti. I've talked about Yeti the last couple of quarters as well. They have missed those two misses there, 2 out of the last 4 quarters. These are the first misses since its IPO in 2018. So kind of significant that they're starting to miss here. But a lot of these consumer companies kind of got caught on the wrong side of the COVID slowdown, so to speak. So they did well during the pandemic when everybody was rushing to get outside because Yeti makes the coolers, the backpacks, the drinkware for, life outside of the home. But now we're going the other way, and a lot of these companies caught with too much inventory that they have to mark down. So they've missed 2 out of the last 4, as I said. But 2 year stack, these shares are now down 51%. So you'd think, hey, maybe this is a buying opportunity here. They have seen a little bit of green here in 2023, up 6% for the year, but still trading at 20 times forward earnings. Is that cheap enough for the kind of growth Yeti is doing and expected to do the next couple of years? Or should investors be waiting for it to get even cheaper on a PE basis? We're going to find out what their outlook is looking like shortly, but Yeti, popular stock with a lot of growth investors, and this is one I'm going to be watching this week. So it's an interesting mix of names this week. And as I said, we still going to get a lot more of the retailers, including the beauty retailers, and beauty remains a hot area of the retail market, and I'm expecting it to remain that way, yeah, at least until the end of the year, but maybe even beyond. So that's also something to watch as we get some of those beauty retailers like Elf Beauty and Ulta Beauty coming up here at the end of earnings season. But otherwise, I'm going to wrap it up for this earnings season with the videos. However, I will be tweeting out charts for all of these retailers and any other hot companies that I know you're going to be watching in the next couple of weeks. And then I'll be back for the second quarter earnings season right in the middle of summer. That should also be an interesting one. But this earnings season, not as bad as what everybody thought it was going to be. And what does that mean going forward? We don't know, but it's good to see that a lot of these companies are handling the economic slowdown so far. They're getting rid of excess inventory and they're kind of righting the ship with their balance sheets. And that's all a good sign for heading into 2024. You can get all of our videos as always. You can get our top stock picks of the week if you want some more stock picks, all on zacks.com/YouTube. Follow our YouTube channel. You'll see all the content there. And I'll see you again in the summer for second quarter earnings season.